My parents charged me $230,000 rent for their paid-off house until the forensic accountant came. I'm Soren, 35, male, senior financial analyst at a consulting firm in Seattle, Washington. I run models for a living, revenue projections, cost structures, variance analysis, and the reason I'm good at it is that I don't let the story I want to be true interfere with the numbers telling me what is actually true. I learned that discipline the hard way, in the most personal context possible, from two people who were counting on me to never apply that discipline to them. For 6 years, I paid my parents $230,000 in rent to live in a house they owned outright. No mortgage, no liens. A paid-off property in Tacoma that my parents had owned free and clear since 2009. Every dollar I paid was supposed to go, per our agreement, into a dedicated account that would eventually help me with a down payment on my own place. It was a family arrangement, a helping hand that made financial sense for everyone. The account didn't exist. I found out because a forensic accountant called me, not one I'd hired, one that had been brought in for a completely unrelated reason by a third party. And what she found, when she looked at where my money had actually gone for 6 years, was not a down payment plan. It was a paper trail to 3 different destinations, none of which were mine. Let me tell you the whole thing. In 2017, I was 27, 2 years into my analyst career, living in an overpriced apartment in Seattle, and commuting to a client site in Tacoma 3 days a week. My parents had been living in their Tacoma house since 2001, had paid it off entirely by 2009, and had relocated to Phoenix for my father's retirement in 2016. The house sat empty. It was a reasonable 1,900 square foot property in a decent Tacoma neighborhood, assessed at around $280,000 at the time. My mother proposed the arrangement during a phone call in early 2017. The family logic was clean. The house would otherwise sit empty and depreciate from disuse. I would save money on Seattle rent while building toward ownership, and the rent I paid, $1,800 per month, slightly below market for Tacoma, would go into an account they'd set up specifically for that purpose, to be returned to me when I was ready to buy. They'd handle taxes and maintenance from that account. Whatever was left when I moved out would be mine for a down payment. I thought about it for a week. I ran the numbers. At $1,800 per month, over a projected 5 to 7 years, I'd be accumulating $108,000 to $151,200, minus whatever maintenance and taxes cost. For a paid-off property in Tacoma, property taxes were manageable, maybe $4,500 a year, and maintenance on a well-kept house shouldn't run more than a few thousand annually. The math worked. I'd be building equity indirectly while living below market rate. I moved to Tacoma in March 2017. The arrangement was verbal. I've thought about that many times since. No written agreement, no documentation of the dedicated account, no legal structure around what was an essentially informal financial relationship. I was 27 and my parents were my parents, and it didn't occur to me to treat it like a transaction requiring paperwork. That was the first and most consequential mistake I made. For 6 years, I paid $1,800 per month into a joint account my parents had given me access to deposit, not to withdraw or view statements. They told me the statements would be confusing because both maintenance expenses and accumulating payments would show up together, and they'd give me a full accounting when I was ready to buy. I accepted this. I deposited every month. I paid on time, every time, for 72 consecutive months. During those 6 years, I also handled everything that came up in the house personally. A water heater replacement in 2019. I found the contractor, I was on site for the installation, and my parents reimbursed me from the account. Roof repair in 2021 after a windstorm. Same process. HVAC service annually. I treated the house like mine because I was living there and I cared about it, and I assumed the financial side was being maintained with the same care. The house appreciated significantly. By 2022, the Tacoma market had moved substantially, and I had the property informally assessed when I started thinking seriously about buying it from my parents. The estimate came back at $485,000. Against a $0 mortgage, that was $485,000 in equity to my holding. I raised the idea of purchasing the house directly from them in early 2023. My mother's response was warm and vague. "We've been thinking about that too. Let's figure out what makes sense." My father was less warm and more specific. He thought the market valuation was the appropriate sale price, and that what I'd paid over 6 years was rent, not accumulation toward purchase. That sentence, "what you paid was rent," landed differently than I expected. "We had an agreement that the payments were going into an account," I said. "We've been maintaining the property from that account," my father said. "Taxes, insurance, the repairs you needed. There's not as much left as you might think." "Can you send me the statements?" I said. He said he would. He didn't. I asked 3 more times over the following 2 months. Each time I got a variation of the same response. He'd get to it, the statements were with the accountant. He'd have my mother pull them together. The delay was consistent enough and patterned enough that I started doing what I do professionally. I started building a model of what should be there. 6 years of payments, $129,600 gross. Property taxes were to come at an average of approximately $4,800 per year, $28,800 over 6 years. Insurance at roughly $1,400 per year, $8,400. The documented repairs I'd managed, water heater, roof, HVAC, totaled approximately $14,200, some of which I'd been reimbursed for out of pocket, and some of which had been paid directly from the account. Conservative maintenance estimate for a paid-off house in reasonable condition, maybe $3,000 more over 6 years. Total reasonable deduction, approximately $55,000 to $60,000. What should have been in the account? Roughly $70,000 to $75,000. I built a second model. What if the account had been invested conservatively during those 6 years? A simple index fund, average annual return of 7%. The balance with growth would be closer to $95,000 to $105,000. I put the models in a folder on my desktop and went back to asking for statements. The forensic accountant called me in July 2023. Her name is irrelevant, but her role wasn't. She'd been retained by the estate of a deceased business partner of my father, who audited financial records connected to a small LLC my father had been involved in during the 2018 to 2021 period. The estate dispute between my father's former partner's family and my father was something I had known existed in the vague way you know about a relative's unrelated legal trouble. Present but not my concern. She called me because my name had appeared in the LLC's financial records as an associated party on one of the accounts she was auditing. "I want to be clear that you're not a subject of this inquiry," she said, "but your name appears as a secondary contact on an account that received deposits that I need to trace. Can you tell me about your relationship to a joint account at a Tacoma credit union?" I told her about the rent arrangement. She was quiet for a moment. Then, "What was the account number?" I gave her the account number I'd been depositing into for 6 years. Another pause. "That account is listed as an operating account for the LLC," she said. "The deposits that match your described amounts, $1,800 per month, consistent from March 2017, are logged in the LLC's books as business income." I sat very still. "Are you saying my rent payments were going into a business account?" I said. "That's what the records show," she said. "I can tell you what I'm seeing on my end. I'd strongly recommend you speak with an attorney before we talk further." I thanked her, ended the call, and sat at my kitchen table for about 10 minutes. Then I called an attorney. The attorney I called was a financial fraud specialist in Seattle. I found her through a referral from a colleague who had used her for a contract dispute, and I explained the situation in a single email that she responded to within 2 hours. We met the following week. I brought my 6 years of deposit records. I had kept every transfer confirmation, a habit from my professional life that turned out to be the most valuable thing I'd done in this whole situation. I had documented every payment, every date, every amount. I had photos of the account I'd been depositing into, taken years earlier when I'd been on site for a repair, and had my parents log in for the day to confirm a payment had cleared. My attorney spent 2 days reviewing what I brought and requesting records through channels the forensic accountant had opened with the court in the LLC dispute. What she found built a picture that was significantly worse than I had modeled. The account I'd been paying into for 6 years had indeed been used as an LLC operating account. The LLC was a real entity, a small property management company my father had started in 2017. The same year the rent arrangement began. The company had never generated significant independent revenue, but it had received $129,600 in deposits over 6 years, logged as property management income, and that money had flowed to 3 destinations. My father's personal account in amounts that corresponded to his periodic cash needs, a second account associated with a renovation project on a property in Arizona that my parents had purchased in 2020, and a brokerage account in my mother's name. There was no dedicated down payment account. There had never been one. The account they had described to me was the LLC operating account, and my 6 years of payments had funded my father's retirement lifestyle, an Arizona investment property, and my mother's brokerage. The property taxes on the Tacoma house, which were my parents' legal obligation as the title donors, had been paid. Insurance had been paid. The repairs I managed had been covered, though the actual disbursements were smaller than the amounts I'd been told they totaled. Everything else had been redirected. My attorney identified 3 primary legal theories. First, breach of contract. The verbal agreement that my payments would be held in a dedicated account and returned to me constituted an enforceable contract under Washington state law. Washington recognizes oral contracts and the consistent pattern of conduct over 6 years, along with my documented deposits and their verbal representations about the account's purpose, was sufficient to establish the agreement's existence. The fact that the money had gone elsewhere was a clear breach. Second, fraud. My parents had made material misrepresentations about the nature of the account to induce me to continue making payments. This was not a case of a vague promise that had simply gone unfulfilled. This was a specific representation about a specific account that did not function as described, made repeatedly over 6 years. Washington's Consumer Protection Act and common law fraud theories were both potentially applicable. Third, unjust enrichment. Regardless of the contract and fraud theories, my parents had been enriched by $129,600 of my money, applied to their own financial interests, without my knowledge or consent. Restitution was appropriate. My attorney also noted that the forensic accountant's findings, which were going to be part of the LLC estate dispute regardless of what I did, would be documentary evidence in any proceeding I brought, since the same financial records established both the LLC fraud on my father's partner and the misappropriation of my payments. This is not a difficult case on the merits, she said. The documentation is clean, and the forensic accounting work has already been done. What does it mean for my parents legally? I said. On the civil side, they're liable for the full $129,600 plus interest and potentially your attorney fees under the CPA claim. On the criminal side, she paused, Washington has a criminal statute for theft by deception, representing that funds would be held in a dedicated account and then systematically redirecting them to personal use is within the definition. Whether the King County or Pierce County DA pursues it depends on prosecutorial discretion, but the elements are there. I asked her to send the demand letter. The demand letter went to my parents in August 2023. My attorney's letter laid out the full accounting, deposits, destinations, discrepancies, and demanded return of $129,600 plus 6% annual interest from the date of the first payment, bringing the total demand to approximately $158,000. The letter specified a 30-day response window and noted that failure to respond or engage would result in civil filing and a referral to the Pierce County District Attorney's Office for review. My father called me the day after the letter arrived. His opening was, "You hired a lawyer against your own family." "I hired a lawyer because you took $129,000 of my money and put it into your business and your investment property," I said. "It was more complicated than..." The forensic accountant traced every deposit, I said, to the LLC account, to the Arizona property account, to Mom's brokerage. "I have the records." Silence. "We were going to settle up," he said, "when the timing was right. For 6 years you told me the account was building. You described the balance to me in 2020 when I asked. You gave me a number. An estimate. An estimate of a balance in an account that didn't exist," I said. "That's not an estimate, that's a lie." My mother got on the call. Her approach was different, more distressed, less defensive. She said they'd made mistakes, that they'd always intended to make it right, that the Arizona property had been an investment they planned to use to repay me. "The Arizona property isn't mine," I said. "The $129,000 is. Your 30 days starts when the letter was delivered. Have your attorney call Mom." They hired an attorney. He sent a response letter 2 weeks later that disputed several of the characterizations in my attorney's demand, while acknowledging that there may have been a misunderstanding about the account structure. That phrase, misunderstanding about the account structure, became the central point of contention in the negotiations that followed. My attorney responded with the forensic accountant's records, subpoenaed from the LLC estate tax, showing the precise flow of my deposits into LLC operating expenses and from there into personal accounts. The misunderstanding framing did not survive contact with specific documentation. Mediation was proposed in September. Both parties agreed. The mediator was a retired King County judge. I want to describe the mediation because this is the part that matters. My parents arrived with their attorney and a revised narrative. The account had been mismanaged, not misappropriated. My father's LLC business had been separate from the rental arrangement, and the commingling of funds had been an accounting error. They had always intended to make me whole, and would demonstrate that with a repayment plan. My attorney presented the forensic accountant's full analysis. The timeline of deposits. The tracing of funds. The Arizona property purchase, timed 18 months into the rent arrangement, funded in part by accumulated deposits from my account. The brokerage contributions. The LLC expense logs that categorized my rent payments as business income going back to 2017. The mediator looked at my parents' attorney at one point and said simply, "Is there a good faith dispute about where the deposits went?" Their attorney paused. Then, "Our client acknowledges the account structure was not as described." "Then what are we negotiating?" the mediator said. The answer, as it turned out, was only the amount. My parents wanted to settle for $90,000, arguing that taxes, insurance, and maintenance reduced the principal legitimately owed. My attorney countered that the taxes and insurance were their legal obligation as property owners, not deductible from a down payment fund, and that maintenance costs, properly documented, totaled far less than my parents were claiming. After 4 hours, the settlement was reached at $138,500. The full $129,600, principal plus interest from the date of each deposit, minus only documented maintenance costs, my attorney accepted as legitimate. My parents were also required, as a condition of the settlement, to transfer title of the Tacoma house to me at no additional cost, valued in the agreement at $485,000, but with the settlement amount treated as a credit toward that value. The net result: I received the house and $138,500 in cash, against a claim that had started as a verbal promise without a down payment fund. The Arizona property was theirs. The brokerage was theirs. The LLC was dissolved as part of the estate dispute, separately, in a proceeding I had no direct role in. The Tacoma house is mine. I'm living in it, the same house I've lived in since 2017. with a completely different understanding of what it is and how I came to own it. I had the locks changed, which felt necessary even though my parents hadn't been there in 2 years. I had the HVAC service. I repainted the kitchen. My parents and I are not in contact. That wasn't a dramatic decision. It was the outcome of a process that stripped away any remaining pretense that the relationship had been functioning as I'd understood it. They had spent 6 years telling me a story about a dedicated account while directing my deposits into their retirement plan. The story had been the entire product of our arrangement. My attorney filed the referral to the Pierce County DA's office as we had indicated we would. The DA's office reviewed the material. I don't know what, if anything, will come of it. Prosecutorial discretion is real, and civil resolution sometimes affects criminal referral decisions. My attorney advised me that I had fulfilled my obligation by making the referral and that the outcome was not mine to control. The forensic accountant, the one whose call started everything, testified in the LLC estate case. That case settled separately in a way I wasn't a party to. But her work, done for a completely different reason, on a completely different case, is the reason I have a house that's titled in my name and $138,500 that I've moved into an index fund. My grandfather's watch was in the fire. My grandfather's watch story is someone else's. But I've thought about it since I heard it, because there's something in the texture of it that resonates. The things that get taken from us by people who should have been protecting them. The patience required to respond correctly. The particular satisfaction of a record that's clean, documented, and correct. The model I built in 2023, when I was trying to figure out what should have been in the account, was off by about $8,500 from the final settlement payment. Close enough. I've been known to run conservative estimates. Here's what I want your honest take on, and I want you to be specific. My father's opening line when I called him after the demand letter was, "You hired a lawyer against your own family." Not, "We made a mistake," or "We owe you an explanation." His first instinct was to reframe my response as the problem. So tell me, have you ever been in a situation where someone who wronged you made your response to being wronged the issue? How did that conversation go? Drop it in the comments. Real story, real details. And if you've read this entire thing, from the informal rental agreement to the forensic accountant's call to the mediation room and the house title transfer, and you still haven't subscribed, I have to ask, what's your preference? Because at this point you've done more due diligence on this channel than I did on a 6-year financial arrangement with my own parents. Hit subscribe. I promise the terms are in writing.